Your account executive with Orion Lending. I have got Justin from my team that's on the call with us. And we're going to touch on some down payment assistance. It really does seem to be the hottest product that we have in the marketplace right now. For those of us in California, there's going to be some additional traction because CalHAF is rolling out a new DPA program that's going to hit the market on 3/27. We're doing some enhancements to our DPA program that is going to roll out on April 3rd. So I'll do a couple things, tell you a little bit about myself, my background, Orion Lending. Keep that very brief. And then go into the two programs that we currently offer. And what I would really encourage is we've got a relatively small group. I am more than happy to dive into any questions that you may have and really focus on information that you would like me to go into more detail on. So let's really make that productive. And I don't want to just ramble up here and give you a bunch of bullet points and show you a couple slides. I'd rather go into detail on what would really help you utilize this program and grow your business. So a little bit about my background. I started in wholesale lending right out of college, got a degree in finance and economics, an MBA with an emphasis in marketing, and somehow ended up as a wholesale account executive in 1993. I've been doing it for 30 years next month, have never left the business, nationally ranked by the Scotsman's Guide, top 5 producer in the state of California, top 50 in the country. So we've done a pretty fair amount of business. One of the benefits to that is I've got my own operations team at Orion. So it does allow us to give you a more personalized level of service pretty much across the board. So from setup through funding, you're going to work with the same team, same underwriters, same account manager, which really lets you build that relationship. So you've got a much more consistent level of service from start to finish. In addition to that, some of the benefits to working with Orion. Number one, we've got fantastic technology, especially when it comes to down payment assistance. A lot of the challenges associated with it are multiple packages, multiple 1003s, a real cumbersome, clunky processing operation that in some cases involves your lender underwriting the file and then shipping it out to any city, county, or state that has to re-underwrite the file. With us, we're fully delegated on the programs that we offer. So we will be your single point of contact, single touch. We don't need to send it anywhere else to have loan approval. We've got a dual AUS. We send all of your disclosures out for you electronically. Fantastic pricing engine. As we've seen some volatility in the marketplace, we allow you to lock directly from our pricing engine, which is fantastic. We've got about 15 AMCs nationwide. We allow you to select the AMC that you would like to work with. So we can certainly help you there. In addition, we've got a very detailed marketing library that will help you put together some very customized professional marketing to really promote any of the programs that we have to offer. We've got some fantastic DPA marketing. So a little background on myself and the company. I'll jump into some of the programs. And like I said, if you guys have questions, please ask. I don't want to just sit up here and ramble on. I'd like to make this really valuable for you. So we offer 2 programs. And I know you guys are licensed in 44 states. You offer loans nationwide. Both of the DPA programs that we offer are nationwide programs. In fact, the only state that we can't lend on one of the programs in is Washington. Other than that, they're available throughout the country. We offer the Chenoa Down Payment Assistance Program, which is actually funded privately through the Paiute Indian tribe out of the state of Utah. We have a second down payment assistance program that is our own proprietary program. We call it Boost. And that is something that we underwrite, we fund, and we securitize. So fortunately, with one of our investor partners, we get to write the guidelines for this program. So I'm going to give you information on both of them. It's kind of interchangeable. I'll tell you where we are with respect to the program right now. And then I will share with you some of the enhancements that are going to be rolling out in 2 weeks on April 3rd. So literally at this point, less than 2 weeks from now. So bullet points on the program. We go down to a 600 credit score on both Chenoa and Boost. Both programs utilize an FHA First Trust Deed. Boost gives us an additional enhancement to offer a USDA First Trust Deed on both programs. your client does not need to be a first-time home buyer. Chenoa has literally no income limits. You could have a client that makes $1 million a year on a W-2 and they qualify for down payment assistance. The Boost program goes to 160% of either the county or state income limit. So I'm based in California. The bulk of our DPA that we do is in the state of California. That's not to say we can't do it nationwide, but I'm just more familiar with the product in California. So for example, the Boost program gives us an income limit of $162,500 in California. And that's utilizing the state income limit, which is actually higher than any of the county income limits.
Jason, can
Yes,
you
Brian.
share your screen with us? Yeah.
Share my screen?
Yeah. Share like the matrix for the DPA.
Actually, yes, absolutely. Justin, can you pull up the matrix for the Boost program? I'd like to see Lan joining the call while she's driving. That's always exciting. Just make sure you don't crash. So yeah, we'll get Justin to pull up the screen share. And what I can do, Brian, I can send you the matrix for both programs along with all of the bullet points that we're going to talk about. We're going to look at another Excel spreadsheet. I'll send you all of those attachments if you could share that with the team, or send me an email where I could share everything with the team. But we'll get Justin pulling that up momentarily. So like we said, FHA first trust deed on both programs, USDA for Boost. In addition to that, we follow the 4001. So the Boost program literally has absolutely no overlays. It follows FHA guides to a T, which means if you've got a client with an AUS approval with a 47 front end, 57 back end, we will take that all day long and fund that loan. In most cases, down payment assistance programs are looking for first-time home buyers. They're looking for low to moderate income borrowers. So you're generally looking at 80% of the county AMI. And then on top of it, you're going to be restricted on debt ratio to a 45%. So we basically shatter all of those problems. Our clients don't need to be a first-time home buyer. We've got aggressive to no income limits. And while Boost will go to 160% of the county AMI, they will also consider exceptions if we're even close to that number. When we're looking at income, that's based on occupant borrowers. So in a lot of cases, your down payment assistance is going to be looking at total household income. In the case of our programs, it's occupant borrower only. So if you've got a married couple whose parents or adult children live in the home and they're income earners, most DPAs would be looking at income from each one of those individuals. We're looking at only the person from the household that's going on the loan. So in the case of a non-occupant cosigner, that non-occupant cosigner's income would be used in determining your debt ratio, but their income would not be used in determining income eligibility for the program itself. Following AUS gives us a tremendous amount of flexibility. Like I said, we go to maximum DTI, 47 front end, 57 back end. We're fully delegated on the program. And our turn time is 24 hours at every touch point. So once you upload the file, disclosures will be out within 24 hours. Loan approval will be issued within 24 hours, conditions reviewed within 24 hours, docs closing. We just closed a down payment assistance loan in the state of Texas, which is a little bit more cumbersome because it's a wet state and it's an attorney state, in 13 days from the time it was uploaded until it was funded. So fantastic turn times. We can move as quickly as you do. And I think you'll be really pleasantly surprised with how quickly we can process your files. We'll do manual underwrites on this program. We will also do FHA spot approvals. And when we say FHA spot approval, that allows us to lend on condos in complexes that are not currently FHA approved. And I will tell you that I've done a large number of spot approvals on the down payment assistance. It does not add any additional time to our closing turn times for this program. As I mentioned earlier, we do allow for non-occupant cosigners on this program. Anyone that's eligible for an FHA loan would be eligible for our down payment assistance. Most of our competitors on the DPA do not allow for DACA borrowers, and we do. So any permanent, non-permanent resident aliens, including DACA, is eligible for our Boost and Chenoa program. Funds to close can be from any eligible source for an FHA or USDA loan, which would include borrowers funds, gift funds, and seller credit, or any combination thereof. We can also work with any additional county or city housing grants for down payment assistance. And we have a couple of those in California that we can recommend or refer you to. Eligible property types for this program would include single family residence, condos, 2 units, manufactured homes. And we've got both forgivable and repayable seconds. We technically are able to offer seconds at either 3.5%, which would be 100% CLTV, or 5%, which would cover some closing costs. But the cost associated with a 5% second has really gotten to the point that it's counterproductive, quite frankly. Closing costs will be less for your client utilizing a 3.5% second than it would on a 5% second, which on the surface doesn't really make any sense, but they've added price adjustments that are pretty exorbitant for the 5% second. So that's really the program in a nutshell. I know I went pretty quickly. Does anybody have any questions on this program? No?
Jason,
Hi, Jason.
yeah, go ahead.
Okay, I love it. We go from no questions to multiple questions. So, Tiffany, did you have a question?
Yes, I do. So you say the Boost program, can you hear me? Sorry.
I got you.
You say on the Boost program, you allow non-occupancy borrow?
Yes, we do allow a non-occupant cosigner on the Boost Pro. We actually allow that on Boost and Chenoa.
Okay. And you said the income of non-occupants borrower will not be used toward the income limit.
Correct. So when we determine the DTI, we will add the combined income of both occupant and non-occupant cosigner and the combined debt. And but when we are determining that income eligibility, for example, we want to keep your client under $162,000, we do not take the non-occupant cosigner's income into consideration in that specific calculation. So yes, that is correct.
Okay.
Excellent question, Tiffany. Thank you. Brian, I think you had a question also. Thank you for jumping in.
So you mentioned it that Orion Landing do not do manual underwriting for these programs?
No, yes, we will do manual underwrites for this program.
Okay.
Yes. So Chenoa has always done manual underwrites. Manual underwrites on the Boost program is one of the enhancements that's going to roll out on April 3rd. And just to give you some insight into that April 3rd rollout, a couple of the changes that you're going to see coming. Number one, we're going to drop the credit score requirement from a 600 down to a 580. And again, this is our proprietary program. We will be the only company offering this in the country. So I believe this will allow us to be the lowest credit score offering DPA program available at a 580. In addition to that, we will be offering and allowing the 2-1 or 1-0 buy down in conjunction with the down payment assistance to help your clients get in with that lower payment for the first year or two. On the repayable seconds, every lender that offers a repayable second has a 10-year term on that second. We're expanding the term to 15 years. So again, we will be the only lender in the country offering DPA with a 15-year second. We will be allowing manual underwrites on the Boost program effective 4/3. If we had one that comes in a little bit sooner than that, it looks like we'll go ahead and manually underwrite that prior to. So that's some good news. We're also expanding the product type, meaning or the property type. We will now be offering the down payment assistance up to 4 units. So you'll be able to offer your clients and your realtor partners 100% financing up to 4 units owner occupied using FHA financing. Compensation on this is borrower paid, and we'll touch on that in just momentarily, but it's currently capped at a 2% origination fee. We're going to be increasing the origination fee that's allowed from 2% up to 2.5%. And if you do opt for a repayable second, you'll be able to match the pricing on the second to the first. So for example, if your pricing on the first trust deed was at 7.5% or 7.25%, the second is currently at 2% above the first, meaning if you're at 7.25% on the first, you're going to be at 9.25% on the second. We're going to give you an option to actually match that second to the interest rate on the first. So now you'll be able to offer your client a 7.25% on the first, 7.25% on the second, with that second being amortized over 15 years. So the enhancements that we're rolling out are really going to be tremendously advantageous for your clients.
Justin, I
Justin,
have a question.
yes, Tiffany.
On the multiple units, so if my buyer is gonna be using one unit but renting out the other, does that affecting the occupancy issue?
So if they're going to occupy one unit, they would meet the occupancy requirement that it's owner occupied. Now we would, following HUD guideline, allow you to utilize rental income from the other 3 units to qualify. Now that rental income would be considered qualifying income, so it would help your DTI, but it would also be considered income in determining that income eligibility at 160% of the county AMI, county or state AMI. But you would be able to use that income to qualify. Now, for example, if we didn't need that income to qualify, we do have some flexibility. If we didn't need the rental income to qualify, I wouldn't have to use it, which means I wouldn't have to use it in determining your county AMI eligibility.
Okay.
Which of
I
the two
wasn't-
programs do you not do in Washington?
We do not offer the Boost program in Washington. So we offer Chenoa only in the state of Washington.
Thank you.
You're welcome, William. Thanks for the question. Tiffany, did you have another question?
Yes, so I was not 100% sure. So the slide we are seeing over here is talking about forgivable and repayable. Can you touch base on that again one more time?
Yeah,
I
I'm going to
think
go
I
into a
might
little
have
bit more
missed
detail on that right now.
Oh,
So-
okay.
Yeah, Justin, can you screen share with me? I'm going to pull up a spreadsheet that is going to give you a lot more detail on the 2 programs that are available. Okay, so are you guys able to see the Excel spreadsheet that I have up on my screen?
Yes, yes.
Okay, fantastic. All right, what I'm going to do is I'm going to walk you through the 2 different programs. One of them is forgivable, one of them is repayable. So on the surface, if Brian was buying a home and we gave him the option to take a forgivable second versus a second he has to make a payment on, every borrower would obviously select the forgivable second. So the question becomes, why would anyone take the repayable second? And I will answer that question for you right now. Go into the specifics on both the forgivable as well as repayable, and then walk you through what a typical scenario or transaction would look like for your client from a cost standpoint, which is really what everyone is concerned about. So this is a screenshot of today's rate sheet. And I will blow this up a little bit so that it's a little easier for you guys to read on your screens. What we're specifically going to be looking at initially is the rate sheet. So here's a screenshot from today's rate sheet. This is pricing on the repayable second. The repayable second is exactly that. It's a second that they need to repay. They do make a payment on it. They begin making the payment when the first payment is due on the first trust deed. That payment is included in the DTI. So there is a DTI impact of doing the repayable second. Currently, it's a 10-year loan. The note rate is 2% above the rate on the first. So if the rate on the first is 7.5, the rate on the second is 9.5. That is amortized over 10 years. As we just discussed, on April 3rd, we're going to be extending that term from 10 years to 15 years. We will also give you the option to, for a cost, have the rate on the second match the rate on the first. So now, effective April 3rd, you'll be able to do a second. It's a 15-year term. And if we're at 7.5 on the first, we'll be at 7.5 on the second. To give you an idea, pricing on that is at 7.5, which is highlighted right here, and it's paying a lender credit of 1.768%. So there's a significant lender credit available at 7.5 on the repayable second. I'm going to scroll down. And here is pricing on the forgivable second. The forgivable second is exactly that. It's a forgivable second. In the case of the Boost, it's forgiven after 10 years. In the case of Chenoa, it's forgiven after 36 on-time payments on the first. It's a silent second, so they don't ever make a payment. There's no interest rate, so there's no accruing interest. So for example, if the initial first was $15,750, if they made payments on this for 1.5 years or 2 years and decided to sell or refinance and had to pay this second off, they would just pay the original note amount. There would be no accruing interest. That balance is never going to go up over time. There's no prepayment penalty on it. So if they chose to pay it off or pay it off early, there's no penalty to do such. But comparing apples to apples now, the interest rate on the forgivable second at 7.5 is at a 0.482 cost. So we're comparing a 0.482 cost on the forgivable to a 1.7 credit on the repayable. So you're looking at about a 2.25% price difference. So difference in fee between the forgivable and the repayable. So the question everyone asks initially is, why would anyone take the repayable second? Because you're going to have a significantly improved cash to close amount utilizing a repayable second. So for a lot of our down payment assistance clients, they're squeaking in. They don't have any additional funds. They don't have gift funds available. There's no 401k that they can liquidate. So the reason that they would select a repayable second as opposed to the forgivable, and we'll go into the details on that from a numbers standpoint in just a moment, is it's going to decrease the cash to close. So for your clients that are really squeaking in and they've got $5,000 in the bank and they want to buy a $450,000 house, they may have to utilize the repayable program for that very reason, cash to close. And I'll show you what that's going to look like right now. So I've put together a quick spreadsheet. And I know some of you are scattered throughout the country. I know 450 may be a little low for some of you on the call. 450 may be a little high, but it's an arbitrary number just to give you some tangible look at what these numbers look like. And if I go too quick and you want me to slow down, I'm happy to do so. But I've selected a sales price at $450,000. Is everyone just thumbs up following what I've got? Okay, I'll assume that's a yes. The 3.5%, so this is utilizing an FHA First Trust deed. The 3.5% down payment is $15,750. Like we said, if you've got a client that comes to you and says, Brian, I want to buy a $450,000 house. I've got $5,000 in the bank. Most loan officers are going to say, I can't help you. You've got to come back when you've saved up 3.5 or 5% down. I'm going to show you how we can very clearly close escrow for that client. You're going to get a First Trust deed at $434,250. With our Chenoa or Boost down payment assistance program, you're going to get a 3.5% second, which is going to cover the entire down payment at $15,750. In this scenario, we're using a repayable second. On the repayable second, we've selected a rate at 7.5, which is paying a lender credit of 1.768%, coming straight off the rate sheet. Estimating your closing costs. When I say closing costs, I'm talking about third-party charges, title, escrow, prepaids, of 2%. And I will send you guys this spreadsheet. I'll send it to Brian. He can distribute that to the team. This is a live worksheet. So if you get this worksheet, you want to punch some numbers in and see if a scenario looks like it would work for your client, and you think the closing costs are too high or too low, you could go ahead and adjust this number right here. Based on a 450 sales price, we'd be looking at $9,000 in third-party charges. Broker origination fee. This is a borrower paid transaction. I want to make sure you get paid the full amount. 2%, which is based on the loan amount, gives you total closing costs of roughly $17,685. If we move down in here at $17,685, we offset that with your lender credit for the interest rate selected at 7.5. That gives us $7,600 toward closing costs. At this point, if you've got a client that's got very limited funds, you just need to tell your realtor partner, go get this borrower in escrow. You need to get us a 2% seller credit. If you can't get a 2% seller credit, we're not going to be able to close escrow. So it's imperative that you really work your way through this transaction with your realtor partner. If they go out, get this client in escrow with a 2% seller credit, using that to offset total costs and fees, you could literally close escrow with $1,000 from your borrower. Any questions on how I put those numbers together? Okay, no questions at all. So literally your client would probably have had to have put a $3,000 to $5,000 EMD into escrow. It is not atypical that in one of these transactions, we can close escrow with enough seller credit with absolutely no money from the borrower and have their EMD refunded to them at the close of escrow. I mean, it's such a powerful program. We've literally had to get borrowers to send us proof of how they paid for their appraisal so that we can include that as a closing cost and then refund the cost of the appraisal as well. What I'm going to show you here is the identical transaction utilizing the 3.5% forgivable second. So on a 3.5% forgivable second, exact same numbers, 450 sales price, 15,750 second, 7.5% interest rate, but the 7.5% interest rate on the on the forgivable program is at a 0.482 cost. I've used the same closing costs and origination fee. In this case, we have a 0.482 cost instead of a credit. If you get your client a 3% seller credit, it's going to require them to come in with about $6,700 to close escrow. So as we talked initially, both very powerful programs. The forgivable program is going to require more money upfront from the borrower, but it saves them money in the long run because they don't have a second payment, and that second is then forgivable. So, any questions on what we're looking at now? Is that Tiffany? Are you raising your hand?
Yes.
I'll tell you what, you don't even have to raise your hand. I am more than happy to have you completely just interrupt me and ask any questions you may have.
Sure. So on the 2% commission,
Yes,
that is the maximum, correct?
that is the maximum right now. On April 3rd, that number is going from 2 to 2.5.
So there's room if we want to really have the clients, we can lower it down. And what is the
Absolutely.
minimum?
There is no minimum. In some cases, we have the same, a loan officer that's doing the real estate as well as the loan transaction, and they're earning a full commission on the real estate. And, it's not atypical for us to get a loan origination fee at 0.75 of a point or 1%. There's no minimum that we're going to require you to charge. Obviously, as one of our lending partners, we would like to see you make some money, but you can select your compensation anywhere from 0 up to 2%. And soon it'll be 2.5%.
Perfect. Thank you.
You're welcome. Thanks for all the questions. Any other questions?
Jason, so for this program that can the client refund, how many months the client need to make the payment so they can refinance again to lower the rate because the rate is kind of high, yes, 7.5.
So fantastic question, Brian. And what I will tell you is you're going to have a recorded second on the program. So I'll begin by just answering your question very simply. HUD if we're going FHA, HUD requires a minimum of 12 months from the closing date until you can do an FHA to FHA refinance when there's a second trust deed, when there's a purchase money second trust deed involved. So you would need to keep the property or keep the loan in place for 12 months if the new loan was FHA. If the new loan is conventional and you had sufficient equity, you could refinance after 6 months. As you may know, conventional is now requiring 12 months on a cash out. This transaction would be considered rate and term because it's a purchase money second. So at any point when the client's going to refinance, it would be rate and term. Now, what goes with the answer to that question The Chenoa program will not subordinate the second. So they want to keep that first in place in order to give you that forgivable second. So you would have to be able to have enough equity or enough appreciation to be able to go ahead and do a rate and term refi to pay off the second. On the Boost program, the Boost program will subordinate the second after 3 years. So while you could do a rate and term refinance after 6 months conventional, 12 months FHA, you'd have to have enough equity to pay off the second. Boost would allow you to subordinate that second after 36 months. Now, there is no prepay on the second. We have had countless situations where someone utilized and leveraged the down payment assistance program. For example, somebody was going to be inheriting money. They paid off the second after 7 months. There's no prepay. So literally, we had one second that was paid off literally after about 5 weeks of funding the original loan. We've done a couple of these where we used the down payment assistance as almost a bridge loan for borrowers that wanted to go under contract and close escrow, and they still had a property that hadn't sold yet. And then once that was sold, they paid off the second, waited the 6 months, and they were able to go ahead and just do a rate and term refinance. So fantastic question, Brian. Any other questions, team?
Sorry, I have another question.
Oh, don't be sorry. You're carrying the weight for the whole team, you and Brian. Somebody else has to step up and ask a question here pretty soon.
So you say the second loan is currently is spreading over 10 years and the interest rate is going to be 2% on top of 7.5 in this scenario. So it's going to be 9.5, correct?
That is correct.
So in the first month, the buyer is going to be paying regular mortgage payment on that 96.5% of the loan at 7.5%, and then also paying for the 9% on the 3.5% that you guys lending them, correct?
Yes, that is correct.
And that's going to be over 10 years. So the other one is forgivable. That means they're not making payment at all. So they only make the payment on the first mortgage of that 96.5% of the loan.
That is correct.
Okay.
Okay, excellent questions. Tiffany, you get the gold star so far for the day. Any other questions that anybody may have on the program?
I have a quick question regarding the DPA fund. So is this always available? Because we have another lenders and I spoke with the AE. She's mentioned to me that sometimes the government run out of fund. They cannot fund the 3.5. I just wanted to double check with you guys that the fund is on.
Yes. Don, where are you located?
California.
Okay, I'm in California also. And I've done down payment assistance throughout my career. And any state funded program, I have always eventually run into a problem with funding. The good news, both of our programs are privately funded. So as I had mentioned earlier, one of them is funded by the Paiute Indian tribe, ultimately out of the state of Utah. So Indian tribes never run out of money. We have funded Chenoa loans. We rolled the program out about 3 years ago and really embraced this. We're actually Chenoa's top producing lender in the country. And we have never had a problem with Chenoa funding. Well, we funded, but we've never had a problem with Chenoa purchasing loans from us. This is a very viable element of the tribe's revenue, and I don't ever anticipate problems with that. The Boost program, we fund directly. And we're a division of American Financial Network. We're funding in excess of $1 billion a month. And while I can't say we will never run out of money for this program, again, it's privately funded. We're backed by a nationwide entity that we partner with on this program, and we've never had funding issues here. I will agree with you 110%. They're probably talking about the CalHAFA program, which is funded by the state of California, which routinely, they allocate X number of dollars for their down payment assistance programs. And when they hit that threshold, when they hit that number, the funding is gone. And I've actually had loans in process back in 2011 when the state ran out of money, and every one of those programs was eliminated immediately. And for you that's in California, Don, for example, they had their Equity Builder program that they rolled out. Gosh, it must have been back in April or May of 2022. And that program ran out of money and ran out of funding. So the Equity Builder program is no longer available. In fact, CalHAF is going to be rolling out another program on March 27th, which they've already said has a limited amount of funding. So the good news is, working with us, the programs that we offer, they don't run out of money. So there's not a whole lot more that I could do to reassure you of that, other than tell you that it's privately funded. There's no allocated specific amount. We will continue to fund loans. These loans are very profitable for us. They're good for the consumer. They're good for the broker. It's good for our business as a whole. So we would love to grow our business on this program specifically, and we have no limitations or specific allocation for funding.
Thank you.
You're welcome, Don. Thanks for the question.
Jason,
Yes.
so 3.5% in your example, is that like the maximum amount that you guys having?
So no, actually, Chenoa offers a 5% second. So going from a 3.5% second to a 5% second gives your borrower 1.5% toward closing costs. What's crazy is they charge you 1.8% LLPA to get the 5% second. So if you do the math, you're paying 1.8 to get 1.5. It doesn't make any sense. You're actually paying, which I assume they're doing this intentionally because this isn't rocket science, that they're deterring people from utilizing that program. So you literally would have a lower cash to close for your client by utilizing the 3.5% second as opposed to the 5% second. So right now, the way that we would leverage money to offset closing costs would be utilizing the repayable program with lender credit or getting seller credit to help with cash to close.
Sorry, I joined late. So can you tell me this program is applied in Texas as well?
I'm sorry, is the program what?
It works in Texas as well?
Oh,
Is it
yes,
nationwide?
yes. Yep, nationwide. The only state that Boost will not lend in is Washington. We do quite a bit of business in the state of Texas on this program. So you've got some unique requirements in the state of Texas. We're very familiar with them. And in fact, we just closed a loan in 13 days in the state of Texas on this program.
Okay, thank you.
You're welcome. All right, so while I've got you as a captive audience, if you have any more questions on the down payment assistance, please feel free to ask. Just to touch on some of the other programs we offer, we're full Fannie, Freddie, Ginnie Mae seller servicer. We've got some of the best pricing in the industry on our government loans. If you haven't checked us out, please do. Fantastic FHA and VA pricing. If anybody does much VA business, I am the only lender in the country, and I've waited my entire career to be able to say something like this. I'm the only lender in the country that will allow you to charge more than a 1% origination fee on a borrower-paid VA transaction. We've got a very unique way of looking at that. We have done thousands of loans in that manner. We're one of the top VA lenders in the country. So if you have questions on VA, we're a certified VA expert. Feel free to give us a call. Happy to answer those questions. We've got a full service non-QM product menu, bank statement, P&L, asset depletion, asset deterioration. We've got a fantastic DSCR program that we still have a no ratio element to. We allow you to lend in 34 additional states with no licensing. So I know you guys are licensed in 44 states, but if you don't happen to be licensed, so let's say Brian wants to do a loan in Wisconsin, he doesn't happen to be licensed in Wisconsin, we can allow him to lend in Wisconsin with no licensing. If there's a state that you've got a DSCR transaction in that you guys are actually not licensed in, it may be on the list of states that we can allow you to lend in. But Fantastic technology, very quick turn times. You guys are a huge lender. We would love to partner with you and do some additional business. And really check out our pricing. If you've got tough scenarios, we take a very aggressive approach on our underwriting. For example, if you've got conventional loans, borrowers not reporting rental income on their Schedule E, I have a couple ways we could work around that where we still give you rental income for those borrowers. So feel free to ask any questions. Brian, if you could distribute all of my contact info, I'll send you an email as soon as we end the Zoom with some of the attachments from this training. But please feel free to reach out to us. We've got a fantastic pricing engine. We allow you to lock directly from our pricing engine. So if you see a market change coming, we can expedite locks for you. And I'll open it up. Any questions, not just on the DPA, but any programs, guideline questions, anything that we may be able to help you with.
Jason, so you mentioned on March 27, so will Orion also apply for the Alpha Dream for All program?
You know, we are actually, our parent company is set up with CalHAFA. We specifically are not. So it's going to be a pretty simple transition. And we think there's some value in this program that CalHAFA is rolling out. I was just on a call this morning. I don't have the specific timeline, but we will be rolling out CalHAFA, I would guess in the next probably 30 to 60 days. But our primary focus right now are the enhancements to the Boost program. And then coming right behind that, we'll be rolling out CalHAFA, but that's going to require a little bit more system modification. So it'll probably be a little bit down the road. But yes, we will be offering that some point relatively soon.
Okay. And the last question, do you offer the doctor loan?
Doctor loans?
Yeah.
No, we don't have any doctor specific loans.
Okay. Okay.
Okay, guys, any other questions that I can help you with?
Yes, I just want to clarify my understanding on the forgivable. So let's say the buyer doing that, paying the points upfront, and then 6 months later, when they refinance it, the full amount of that 3.5% is going to be forgivable, correct?
No, the forgiveness portion, it's not forgiven for 10 years.
Oh, so they have to keep the loan for 10 years.
They've got to keep the second for 10 years. Yes.
So when they refinance it, it's considered they are no longer keeping it, correct?
Correct. They would. So for example, if they wanted to refinance in 6 months, number one, I would not put them on a forgivable program because there's more cost associated with it. So if your client, for example, came in and said, we're going to sell a property or we're going to get a gift from a family member, but it's not coming for 6 to 12 months, I would put them on the repayable because you're going to be able to get some lender credit, decrease cash to close for your client. There's no sense paying the additional upfront fee if you're not going to keep that loan long term. But if they were to go ahead and refinance in 6, 12, 18 months, they would pay back the second. They would pay back just the original note amount. It is a silent second with no interest rate, so there will never be accruing interest.
On the payable one, you're talking about on the payable one, it's
I'm talking about
interest accrual.
No. On the forgivable, there is no accruing interest. On the repayable, there is an interest rate. They do pay interest and they would make a monthly payment on that. So,
Right, so that's what I say, like maybe somebody, they try to have someone helping them, helping the hands of getting into the house, and then 12 months later, they have the cash to pay, but they don't want to pay. So at that time when they refinance it, they will not qualify for forgivable. So the only amount that they have to pay back is whatever you guys lend them, right?
correct. So on the forgivable, yes. So all they would pay back would be the original note amount. There would be no accruing interest. So that balance would never go up. And then on the repayable, if they kept it for a year, they would have made 12 payments and they would have actually amortized, really roughly 1/10 of that loan amount down.
Okay, got it.
Okay, great question, Tiffany. Thank you. Okay, fantastic questions, guys. Any questions on any other programs that we might be able to help you with? Brian, do you guys do much VA business?
Yeah, we send some VA to some VA loan. But we mostly do with the other lenders with VA, because the ETA is fast. So yeah, I think I will try to look over the VA guideline from your portal, and yeah, we will consider VA to Orient also. Yeah.
Yeah, and what I will tell you is, obviously, if you guys do some VA, you know VA has no max ratios like conventional and FHA do. I have no overlays on any of our product. So specifically,
Okay.
we have no problem taking your AUS approval with back end ratios in the 50s, 60s, 70% range.
Okay. Great. Okay. 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 Yeah.
Okay.
I'll take a look at it. Yeah.
Okay. All right, guys. Anything else we could help you with?
Yeah, I think I just have last question. So for the forgivable, so the question Tiffany mentioned, so for when the client apply for forgivable and after seek payment, the refinance rate in term, they have to bring the money to pay off the forgivable, right? They cannot do refinance rate in term and include the balance of the forgivable, right?
Conventional, they actually could go based on new appraised value. So
Oh,
on a rate and term refinance. So for example, if they bought it under market or we went through a period of appreciation, then they would be able to go ahead and do a rate and term, pay off the existing first and the existing second. And that would apply whether it was forgivable or repayable.
okay, okay.
But yes, so just to clarify, on the forgivable, if we do the boost forgivable, it's not forgiven for 10 years. They've got to keep that second for 10 years. On the Chenoa forgivable, they've got to make 36 on-time payments on the first, which means they need to keep the first and the second for 36 months. So I agree. And I think we all would agree that rates are probably going to drop over the next 12 to 18 months. So we may see these clients that are going into DPA willing to go ahead and pay off that second, whether it was repayable or forgivable, if they could drop the interest rate on the first trust deed enough.
Okay, yeah, okay, I'm clear. Yeah.
Okay, fantastic, Brian. All right, guys. Anybody else? I mean, I'm happy to stay on the call, answer any questions. I don't want to take up your whole day if you guys are good and you're set to go.
Please don't forget to send us whatever you just share on screen. Thank you.
I will not. I will send that to Brian literally as soon as we get off this call. The first thing I will do is send Brian an email with every one of these attachments to it.
Yeah, okay. I will forward you guys the recording. Yeah, and the
And then
guidelines.
Justin will send you the recording of today's training.
Okay.
Okay, guys. Well, hey, Brian, thank you very much. I really appreciate you coordinating this. If anybody has any questions, please feel free to reach out to me. If you need credentials to be able to get in price loans, check the guides, do anything in the system, just send me an email. And hopefully you'll have my contact info when Brian forwards my email out to everyone.
Thank you so much. Thank you, Jason. Thank you, Justin.
Okay,
Thank you,
you're
everyone.
welcome, Benjamin. Thank you, Brian. All right, we'll go ahead and shut it down. Tiffany, thanks for all your questions.
Thank you, Jason. Thank you, Brian.
Thanks, guys.
Thank you. Bye-bye, everyone. Thank you.